skill in trading. The ultimate goal is to reach a point where your confidence matches your expertise. This means you trust your strategy because it's been tested. You respect the market's unpredictability, and you follow your rules consistently, knowing that no single trade defines your success. The Dunning-Kruger effect is a natural part of every trader's journey. The key is recognizing it and taking deliberate steps to move beyond the beginner traps and into true mastery. Have you ever experienced the Dunning-Kruger effect in your trading? Share your story in the comments. I'd love to hear how you've navigated this challenge. If you found this video helpful, please like, share, and subscribe to Mastering Market for more insights to sharpen your trading skills. Thanks for watching, and I'll see you in the next video. Have you ever placed a trade that seemed perfect until the market flipped in an instant and left you watching your account balance drop like a rock? If so, you're not alone. Most traders face that sinking feeling at some point. The difference between those who recover and those who burn out is effective risk management. In this video, we'll break down the key elements of risk management and then dig deeper, showing you exactly how to use these tools to safeguard your capital, boost consistency, and build long-term success. Stick around because understanding these concepts can truly transform your trading journey. Risk management isn't just about using stop losses or limiting how much money you put into a single trade, though that's part of it. It's a holistic framework that guides every decision you make, from what markets you trade, to how much of your capital you allocate, to when you exit positions. Think of it this way. You wouldn't drive a car at top speed without brakes, seatbelts, or airbags. Similarly, trading without risk management is like racing down a financial highway with no safety measures in place. So what are the core constituents of a solid risk management strategy? Let's break them down into 5 key areas. 1. Position sizing, determining how much capital you allocate to each trade. 2. Stop-loss placement, setting predefined exit points to limit losses. 3. Risk-reward ratios, balancing potential losses against potential gains. 4. Diversification and correlation management, spreading your bets across different assets and strategies. 5. Emotional discipline and rules enforcement, sticking to your plan, even when it's tempting to deviate. These 5 pillars work together like a well-oiled machine. Each part reinforces the others, ensuring you stay in control, even when markets throw you a curveball. Position sizing is where it all starts. Without a clear method to determine how much capital you put into a trade, you risk putting too many eggs in one basket. For example, let's say you have a $10,000 account. One trader might throw the entire $10,000 into a single stock trade because they're confident about it. Another trader, with proper risk management, might decide to risk only 1% of their capital, $100, in that trade. If the trade goes wrong, the first trader could face a catastrophic loss, while the second trader limits their downside and lives to trade another day. By committing to position sizes that reflect your risk tolerance, you ensure no single loss can knock you out of the game. Over time, this stability compounds, allowing you to steadily grow your account rather than risking it all on one roll of the dice. Next up, the stop loss. This is the safety net that prevents a losing trade from becoming a financial black hole. Placing a stop loss is like drawing a line in the sand and saying, if the market goes beyond this point, I'm out. For instance, if you buy a stock at $50, you might set your stop loss at $48, risking $2 per share. If the stock dips below $48, you exit immediately. This small, controlled loss is far easier to recover from than a trade that plummets unchecked to $40, $30, or even lower. Some traders resist stop losses, hoping a losing position will bounce back. But hope isn't a strategy. Setting a stop and sticking to it ensures you never let a small loss turn into a disaster. Trust me. One of the hardest lessons in trading is learning to accept a loss and move on quickly. Let's talk about risk-reward ratios. This ratio compares what you stand to lose if the trade goes wrong, your risk, with what you stand to gain if it goes right, your potential reward. A common guideline is a 1-to-2 ratio. Risk $1 to make $2. Why does this matter? Consider a scenario. If you risk $100 per trade and aim to make $200 when you're correct, you don't need to be right most of the time to make money. Even a 40% win rate can be profitable. This mathematical edge gives you breathing room. You don't have to nail every trade. By consistently maintaining a favorable risk-reward ratio, you create a structural advantage in your trading approach. It's like running a business where, even if some products fail, the profit margins on your winners more than cover the losers. That's what keeps you afloat and growing over the long term. Diversification is a classic principle for a reason. If all your trades are in the same sector, say, tech stocks, then one piece of bad industry news can sink your entire portfolio. But if you spread your capital across technology, healthcare, consumer goods, and maybe some foreign equities or commodities, a downturn in one area won't cripple your account. Correlations matter too. You might think you're diversified by holding multiple assets, but if they all move together, such as certain currency pairs or markets that respond similarly to macroeconomic events, you're not truly protected. Imagine you're trading futures on oil, natural gas, and energy sector ETFs. If the whole energy complex tanks, everything drops together. True diversification means holding positions that don't all react the same way to the same triggers. All these tools, position sizing, stop losses, risk-reward ratios, diversification, mean nothing if you don't have the emotional discipline to follow them. It's all too easy to ignore your rules when you're caught up in the excitement of a winning streak or the panic of a losing trade. But that's the trap. Your emotions will try to convince you that this time is different. Guess what? It rarely is. Successful traders stick to their rules. They treat trading as a business, not a casino. If you've decided you'll risk only 1% per trade, that's what you do. No exceptions. If your stop loss gets hit, you accept the loss and move on. If you've hit your daily loss limit, you stop trading for the day. By enforcing these boundaries, you shield yourself from impulsive decisions that erode your account and confidence. Let's say you're an intraday trader who likes to capture short-term moves. You start your day knowing you'll risk no more than 2% of your total capital. If you have a $10,000 account, that's $200. For each trade, you use a stop loss that limits you to a $50 loss. That means you can try up to 4 trades before hitting your daily loss limit. If the first trade loses $50, you move on to the next. If your second and third trades each net $100 profits, you're already up on the day. And if you hit your daily risk limit, you stop trading and preserve what's left for tomorrow. This approach ensures longevity. Over time, even if some days are losses, your account will avoid catastrophic drawdowns. Steady gains combined with strict risk protocols build a stable equity curve rather than wild swings. Now, if you're still skeptical about the importance of risk management, consider the alternative. Without it, you're one big trade away from blowing up your entire account. All the analysis and predictions in the world can't guarantee profits if you let your losses run free. Markets are unpredictable, and no trader, no matter how experienced, can avoid losses entirely. The only control you have is over how much you lose when you're wrong. Imagine the feeling of slowly, steadily building your capital, knowing you're protected against any single catastrophic event. That's peace of mind you can't put a price on. By embracing risk management, you're not just protecting your money, you're protecting your future as a trader. Ready to put this into practice? Start by defining your risk tolerance. Decide on a maximum percentage of your account you're willing to lose in a single trade or day. Next, map out your stop losses and calculate your position sizes based on those risk parameters. Test your strategy on historical data. Does it hold up under volatile conditions? If you're unsure where to begin, start small. Risk less, trade smaller positions, and get comfortable following your rules. Gradually scale up as you gain confidence and consistency. Over time, good risk management practices will become second nature. Risk management might not be the most glamorous part of trading. It doesn't promise quick riches or excitement, but it's the bedrock of long-term success. By carefully controlling how much you risk, setting strategic stop losses, maintaining favorable risk-reward ratios, diversifying your bets, and enforcing your rules with iron discipline, you create a trading environment where you don't just survive market turbulence, you thrive in it. If you found this video helpful, don't forget to like and subscribe. Also, share it with fellow traders who need a reality check on risk. Let's foster a community of well-prepared, disciplined traders who understand that the key to winning isn't just making money. It's knowing how to protect it. Thanks for watching, and I'll see you in the next one. What if I told you that over 70% of stock market trades today are executed by algorithms, many of them powered by artificial intelligence? Yes, AI-driven trading strategies have quietly taken over the financial world. And if you're not using these tools, you might be missing out on valuable insights. In this video, I'm going to show you how to harness AI for trading and investing more efficiently, sharing real-world examples, practical tips, and steps to integrate these tools without sacrificing your own human judgment. Stay with me, because by the end, you'll be equipped with the know-how to step up your game in the modern markets. Artificial intelligence has transitioned from a buzzword to an everyday force shaping how we buy, sell, and analyze assets. In fact, recent surveys suggest that institutional investors and hedge funds are increasing their spending on AI-driven solutions by double digits each year. But this isn't just a tool for the big players. Retail investors can now access AI-powered platforms at low costs, and many robo-advisors incorporate machine learning models to build and manage portfolios. So how exactly can AI transform your trading and investing experience? Let's start with the basics: data processing. Humans just can't keep up with the sheer volume of financial data generated every second. Price movements, company earnings, regulatory updates, global economic indicators, sentiment from social media chatter. There's a flood of information out there. AI models thrive in this environment, sifting through massive datasets and extracting patterns that might take you years to recognize, if at all. Imagine a quantitative hedge fund. Each morning it feeds in not just stock prices and trading volumes, but also satellite imagery of retail parking lots, social media sentiment about product launches, and central bank announcements. The AI system identifies correlations. Maybe it spots that when consumer sentiment dips below a certain threshold, certain retail stocks tend to fall the next day. With that insight, the fund can short those stocks ahead of time, capitalizing on information that's hidden in plain sight. But it's not just big institutional players. As an individual, you might use a robo-advisor powered by AI. These services analyze your risk tolerance, long-term goals, and current market conditions. Instead of relying on outdated models, they use machine learning to dynamically adjust your portfolio. Perhaps they detect that a geopolitical event is likely to destabilize a region's market. Your robo-advisor could shift your allocation away from that region's ETFs before the losses mount. Over time, the system refines its decisions, learning which signals accurately predict outcomes and which do not. Then there's the power of natural language processing, a subset of AI that interprets human language. By analyzing news headlines, earnings calls, and social media posts, NLP models gauge market sentiment in near real time. If public opinion on a tech giant suddenly turns negative, say due to a leaked memo on subpar product quality, an NLP-driven model can alert you to adjust your holdings before the market fully reacts. This can mean the difference between locking in gains or watching your profits evaporate. Now, how do you get started using AI efficiently in your own trading or investing process? First, define your goals. Are you looking to enhance your short-term trading results, reduce risk in a long-term portfolio, or just find new investment ideas faster? Having a clear objective helps you choose the right models and data sources. Second, start simple and scale up. You don't have to dive into deep reinforcement learning models on day one. Maybe begin with a basic model that tries to predict price direction using a few technical indicators. Once you're comfortable, gradually incorporate more data, economic calendars, corporate earnings, sentiment analysis. When you see an improvement in your backtests, consider experimenting with advanced techniques like neural networks or ensemble methods. Third, remember that AI is not a magic crystal ball. Even the most sophisticated models will make mistakes. Markets are partially driven by irrational human behavior, sudden news events, and random noise. The true power of AI isn't in perfection, it's in enhancing your odds. It can help you spot opportunities faster, manage risk more proactively, and test new ideas more thoroughly. But you still need your own critical thinking. Combining AI's speed and pattern recognition with your own domain knowledge and intuition often yields the best results. Fourth, data quality is another big factor. Poor data leads to poor predictions, no matter how advanced your model is. Ensure you use reliable, up-to-date information. As retail investors, you can subscribe to reputable financial data providers or tap into APIs offered by established platforms. Clean your data, handle missing values, and ensure the metrics you feed into the model actually matter. It's better to use fewer high-quality features than to flood your model with junk data. Fifth, before putting real money on the line, backtest your AI-driven strategy. Run it through historical data and see how it performs in different market conditions: bullish, bearish, and flat. Check if it overfits, meaning it's just memorizing the past instead of learning useful patterns. After that, try paper trading. Simulate trades in real time using fake money to verify the model's viability under current market dynamics. If it shows promise, then consider a small capital allocation first, and scale up if it consistently delivers. Sixth, keep in mind that markets evolve. A model that works today might fail tomorrow. Regularly update and retrain your models as new data and market conditions emerge. Continually monitor performance metrics. If you notice a drop-off, investigate. Maybe it's time to incorporate new features, adjust hyperparameters, or even switch to a more advanced architecture. Seventh, let's not ignore ethical considerations. If your AI strategy involves monitoring sentiment or trading around corporate announcements, ensure you adhere to regulations. Don't engage in manipulative practices. Likewise, be mindful of transparency. While deep learning models are often black boxes, consider tools that help explain why the model made a certain prediction. This builds trust for you, for clients, and for any stakeholders who may demand an understanding of the underlying logic. To summarize, AI can give you a significant edge by handling more data than you ever could manually, rapidly adapting to new information, and spotting patterns hidden in complexity. Over 3/4 of financial professionals believe AI will be critical for maintaining a competitive advantage over the next 5 years. Don't be left behind. Start small, refine your approach, integrate AI insights with human expertise, and keep a close eye on both performance and ethics. By blending the brute force analytical strength of AI with your personal experience and judgment, you can navigate the markets with greater confidence and efficiency. Whether you're a day trader scanning for quick opportunities, a long-term investor optimizing a portfolio, or just someone curious about the next frontier in finance, AI is here to help you level up. Thanks for watching, and if you found this valuable, be sure to like, subscribe, and share. Your future trades might just thank you. What to do when the market corrects. Picture this. You're sitting at your desk feeling pretty good about your investments. You've been watching your portfolio grow steadily, thinking, this investing thing, easy money. Then suddenly, bam, the market drops faster than your phone battery at 1%. Now what? Sell everything? Blame your broker? Or play it smart? Let's talk about what really works when the market corrects. When the market corrects, it's natural to feel a pang of panic. But here's the truth. Market corrections are normal. They're not some apocalyptic event. They're a regular part of investing, like plot twists in a Netflix drama. And just like in a good drama, you have a choice. Freak out, or follow the storyline to the end. Let me tell you a quick story. In 2008, during the financial crisis, people panicked and dumped their stocks left and right. But a handful of investors, people like Warren Buffett, saw it differently. Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." While everyone else was running for the exits, he went shopping. Fast forward a few years, those who stayed in the market or invested wisely during the downturn made a killing. What's the takeaway? Panic is the enemy of profit. When you see red in the market, don't let it cloud your judgment. Instead, do this. First, hit pause on your emotions. It's easy to let fear dictate your decisions, but investing is a long game. Corrections are just part of the ride. The market has been through wars, recessions, pandemics, you name it. And guess what? It's always bounced back. Next, analyze your portfolio. This is where you separate the winners from the pretenders. Are the companies you've invested in fundamentally strong? Do they have good leadership, solid earnings, and a competitive edge? If the answer is yes, don't sweat the short-term dips. If the answer is no, well, maybe it's time to say goodbye to the underperformers. Now, here's the fun part. Corrections are like Black Friday for investors. Imagine walking into a store and finding everything you wanted at half price. That's what a market correction is. Quality stocks and ETFs that were overpriced yesterday might be on sale today. But remember, don't just buy because it's cheap. Do your homework. Look for value, not just a discount. Let's talk about strategy. Dollar cost averaging is your best friend during corrections. Here's how it works. Instead of dumping all your money into the market at once, you invest a fixed amount at regular intervals. This way, you spread out your risk and take advantage of lower prices when the market dips. It's the ultimate slow and steady wins the race approach. Still not convinced? Let me share another story. During the COVID-19 crash in 2020, the market dropped like a rock in March. People panicked. Headlines screamed doom and gloom. But by the end of the year, the market had not only recovered, it had reached new highs. Those who stayed invested or bought during the dip, they reaped the rewards. And what if you're already fully invested? Hold the line. Selling during a correction locks in losses and shuts the door on potential recovery. Historically, the market has always bounced back, so patience is your best strategy. Here's a tip that often gets overlooked. Diversify. Corrections hit different sectors in different ways. If you're too concentrated in one area, you're vulnerable. A balanced portfolio with a mix of stocks, bonds, and other assets can cushion the blow. Finally, remember this. Your mindset matters. Investing isn't about avoiding corrections. It's about understanding them. Think of them as a stress test for your portfolio and your patience. Every dip is a reminder to focus on your long-term goals and not get caught up in short-term noise. Because here's the truth. Corrections are temporary, but wealth is built over time. The market rewards those who stick with it, who keep learning, and who see opportunity where others see chaos. So the next time the market corrects, don't panic. Plan. Because the difference between losing and winning isn't what the market does, it's what you do. Have you ever wondered how some traders seem immune to the market's wild swings, even when the rest of us are sweating bullets? Today, I'm going to show you exactly how to detach from the outcome of your trades so you can trade with rock-solid confidence. By the end of this video, you'll discover the surprising psychological edge top traders use to stay calm, pivot fast, and turn chaos into opportunity. The first thing nobody tells you is that detachment isn't about being cold or robotic. It's about separating your self-worth from the outcome of any single trade. So how do you actually do that? One powerful trick is to create a detailed entry and exit plan for each trade, before you even open a position. This way, you're not glued to the screen hoping, wishing, or fearing. You're free to make decisions based on logic, not adrenaline. Ever heard of the Zeigarnik effect? It's a psychological phenomenon where our minds fixate on incomplete tasks, like open trades. Successful traders break this cycle with well-defined rules. Once they place a trade, they already know their stop-loss and profit targets. No more agonizing over whether to exit early or hold on too long. This frees them to observe the market calmly, even when it flips unexpectedly. Imagine the market suddenly drops 3% in a single day. A new trader, call him Dan, panics and sells at a huge loss. Meanwhile, a seasoned pro checks their fundamentals. If the core reasons for entering the trade still stand, they might even add to their position at a discount. That's detachment in action, responding logically, not reacting emotionally. So, how do you detach from the outcome in the heat of the moment? One fascinating trick used by pros is a mindful transition break. After a big win or loss, they'll do something mundane like washing dishes or watering a plant to reset their emotional spike. This might sound odd, but research shows a brief, purposeful distraction can normalize your emotional state. That means no revenge trading, no chasing losses. Another angle you rarely hear about is how pros handle losses versus how beginners do. Novices obsess over a painful loss, replaying it in their heads, fueling fear and doubt. Professionals? They examine that loss purely for lessons. Once they extract the key insight, they file it away and move on. It's like archiving a book in the library of your trading career. Still there for reference, but not haunting you every night. Now let's talk about something called emotional set points. Everyone has a default emotional baseline. After a big gain, you can spike into euphoria, which often leads to overconfidence. After a loss, you can dip into despair, which triggers desperation trades. Detachment is about resetting to neutral as fast as possible. One common method is trade journaling. By quickly logging the who, what, when, and why of every trade, you create a habit of reflection rather than an emotional roller coaster. But what if the market itself is the problem? Look at history's extreme moments, like George Soros on Black Wednesday in 1992. He shorted the British pound in the face of massive uncertainty and economic turmoil. That kind of confidence doesn't stem from wishful thinking. It's built on thorough preparation, a solid risk plan, and an unwavering ability to stay detached. He was mentally prepared to handle losses if he was wrong, which paradoxically gave him the freedom to stay the course when the stakes were highest. Here's another technique to detach from outcomes. Think in terms of R multiples instead of dollars. A trade might have a profit target of 2R, 3R, or even 10R, and a stop loss is always 1R. Now you're playing a probability game instead of letting your P&L define your emotional state. You win some, you lose some, and it all becomes part of a consistent approach designed to profit over the long haul. Finally, the hidden benefit of detachment is that it unleashes your creativity. When you're not bogged down by fear or greed, you can spot unique correlations, like noticing a currency pair that moves with a specific commodity, or seeing an unexpected pattern unfold in a lesser-known sector. Stress narrows your focus, but detachment keeps you flexible and observant. So to circle back, how do you detach from the outcome? You adopt a plan that outlines every move, prepare yourself mentally for inevitable losses, and actively reset your emotions with mindfulness breaks and trade journaling. The goal isn't zero emotion, it's zero emotion-driven decisions. When you master this level of detachment, you'll realize it's a serious competitive advantage in trading. That jittery feeling when a stock wobbles? It fades. That urge to win it all back after a bad day? It dissolves. You operate with clarity and poise, even in the face of extreme volatility, because losses are now stepping stones instead of stumbling blocks. If this feels like a wake-up call, it's because it is. Perfecting your next indicator or scanning for a hot setup might help, but the true game changer is your mindset. Start implementing even a fraction of these detachment tactics, and you'll see your trading and your sense of control evolve beyond what you imagined possible. That's the power of true detachment, and now it's yours to wield. Have you ever been so certain about a trade that you ignored every warning sign, only to watch the market turn against you and take your confidence with it? What if I told you that the single most important quality for long-term success in the stock market isn't intelligence, technical skill, or even experience? It's humbleness. Yes, the ability to admit mistakes, adapt quickly, and move forward is what separates consistently successful traders from those who blow up their accounts. Let's be honest, the stock market is unpredictable. It's influenced by countless factors: economic data, political events, global crises, even emotions, and it shifts in ways no one can fully predict. The moment you think you've got it all figured out, the market will remind you otherwise. But here's the problem. Too many traders let arrogance get in the way. When the market goes against them, instead of cutting losses, they hold on stubbornly, convinced they'll be proven right. They're not just fighting the market. They're fighting reality. And here's the hard truth. The market doesn't care about your opinions or your ego. The market always wins. Arrogance in trading often looks like this: refusing to admit mistakes, overconfidence in predictions, and ignoring risk management rules. Maybe you've experienced this firsthand, holding on to a losing position because you believed it would turn around, only to watch your losses grow. These behaviors don't just hurt your account, they crush your ability to learn and grow as a trader. If you're never wrong in your own mind, you'll never improve. So why is humbleness such a powerful quality in trading? First, it limits losses. Humble traders understand that every trade won't be a winner. They know when to cut their losses instead of letting ego keep them stuck in a losing position. Second, it encourages learning. When you're humble, you're willing to reflect on your mistakes and use them to improve your strategy. Every mistake becomes an opportunity to grow. And third, humbleness keeps you open to opportunities. If you're not fixated on proving you're right about one trade, you're free to move on to the next opportunity. This mindset is what opens the door to long-term success in the market. Let me challenge you with a few questions. When a trade goes against you, do you blame the market or reflect on what you could have done differently? Have you ever ignored your stop loss because you believed the market would turn around? Do you celebrate every win without analyzing whether it was skill or luck? Be honest with yourself. Are you truly humble in your trading, or is arrogance holding you back? Here's the good news. Humbleness isn't something you're born with. It's a skill you can develop. Let me share some practical tips to help you cultivate this quality. First, start a trading journal. Document every trade you make, why you entered, how you managed it, and what the outcome was. This habit forces you to reflect and stay accountable. Second, set strict rules and follow them. Use stop losses and position sizing to protect yourself from overconfidence. Write your rules down, and no matter how confident you feel, stick to them. Third, practice admitting uncertainty. It's okay to say, "I don't know." The best traders embrace uncertainty and wait for clarity rather than forcing a trade out of arrogance. Fourth, celebrate your mistakes. Instead of getting frustrated, view every mistake as a step forward. Write down what went wrong and what you'll do differently next time. And finally, surround yourself with other traders. Join communities or forums where experienced traders share their insights and admit their own mistakes. Seeing others practice humility can inspire you to do the same. The reality is, every successful trader you admire practices humbleness. Paul Tudor Jones famously said, "Losers average losers." He knows the importance of cutting losses and moving on. Ray Dalio, one of the most successful hedge fund managers in history, emphasizes learning from mistakes and staying open-minded. And even Warren Buffett admits when he's wrong and adjusts his strategies. These traders didn't become legends by being stubborn. They succeeded because they were willing to adapt, learn, and grow. Humbleness isn't just a nice quality to have. It's the foundation of long-term success in the stock market. It helps you limit losses, learn from mistakes, and stay open to new opportunities. So ask yourself, are you willing to embrace humility and unlock your full potential as a trader? Who really controls the stock market? Let's discover the secrets behind the curtain. Have you ever felt like the stock market is a game rigged against you? Like no matter how much research you do, the prices move in ways you can't predict. Here's a truth bomb for you. The stock market is like a vast ocean, and retail traders like us are just tiny boats. The real waves are created by the big players: hedge funds, mutual funds, and institutional investors. But here's the exciting part. Once you understand how they operate, you can ride those waves instead of being swallowed by them. In this guide, we'll dive deep into who really moves the market, the phases of market cycles, and how you can spot opportunities like a seasoned pro. Whether you're brand new to trading or looking to refine your strategy, this post will empower you with insights that could change the way you approach the market forever. Stay tuned because by the end, you'll know how to trade smarter, not harder. The market is a battlefield. On the surface, the stock market might seem like chaos, a frenzy of numbers, graphs, and news reports. But underneath it all, it's a carefully orchestrated battlefield. Every stock price you see is the result of a tug-of-war between buyers and sellers, governed by the laws of supply and demand. But here's the kicker. It's not us, the retail traders, driving these movements. Instead, it's the institutional investors with their massive capital reserves. When they enter or exit a position, they don't do it all at once. They move in stealth. They accumulate shares slowly during downtrends or consolidations and distribute them strategically during bullish phases. And this creates predictable patterns that savvy retail investors can learn to spot. A common scenario, ever been here? Let's paint a picture. You buy a stock at $100, hoping for a quick profit. For days, the price barely moves and you grow frustrated. Eventually, you give up and sell it, only to watch it rocket to $120 the next day. Sound familiar? If you've been in this situation, you've experienced the power of institutional trading firsthand. What happened here? You were likely holding during an accumulation phase, a period where institutions quietly buy shares. Once their positions are secure, the stock enters the markup phase and the price shoots up. The secret sauce: understanding market cycles. The market doesn't move randomly, it moves in predictable cycles. To succeed, you need to identify where you are in the cycle and adjust your strategy accordingly. Let's break down the four main phases. 1. Accumulation phase. This is where the smart money starts buying after a downtrend. Prices are low, sentiment is bearish, and most retail traders are too scared to enter. Key tip: look for sideways price movement with low volatility and subtle increases in volume. 2. Markup phase. This is where the excitement begins. Prices start to rise steadily, momentum builds, and retail traders begin piling in, driven by the fear of missing out. FOMO. By this point, the big players are already sitting on large positions, enjoying the ride. 3. Distribution phase. Now the smart money starts selling. Prices may still rise, but the upward momentum slows as institutions offload their holdings to latecomers. Retail traders often get trapped here, buying at inflated prices. 4. Markdown phase. Finally, the market begins to fall. The institutions are out, and the retail traders who bought during the distribution phase are left holding the bag. Avoid this phase at all costs unless you're shorting the market. When should you buy? Accumulation or markup? Here's a question for you. If you were buying a stock, would you choose the accumulation phase or the markup phase? Most new traders jump in during the markup phase because it feels safer, but the accumulation phase is where the real opportunities lie. Why accumulation is key: imagine a stock consolidating between $500 and $510 for weeks. It's moving sideways, showing no significant price action. This is where the smart money is buying. By entering during this phase, you position yourself to benefit from the breakout when the markup phase begins. How to spot the end of accumulation. One of the most critical skills in trading is identifying when a stock is about to break out. Here are 3 proven methods. 1. Volume analysis. Volume is like the heartbeat of the market. When you see increasing volume on bullish candles near resistance levels, it's a strong signal that a breakout is imminent. 2. Support and resistance levels. Watch key levels closely. A breakout above resistance or a breakdown below support often signals the end of consolidation. 3. Technical indicators. Tools like Bollinger Bands and RSI can provide additional clues. For example, a contraction in Bollinger Bands often precedes a breakout. Real-life example. The Reliance stock. Let's take the example of Reliance stock. Imagine it's been consolidating around 2,400 rupees for weeks. Suddenly, you notice higher volumes and a breakout to 2,500 rupees. This is a textbook example of the end of the accumulation phase. If you had entered during the consolidation, you'd be sitting on significant gains. Managing risk, the art of moving your stop. Loss trading isn't just about making profits, it's about protecting them. A stop-loss order is your safety net, but many traders use it incorrectly. Here's how to do it right. 1. Trail your stop-loss as the price moves in your favor. Adjust your stop-loss to lock in profits. For example, if you bought a stock at $100 with a stop-loss at $95 and it rises to $110, move your stop-loss to $105. 2. Use the 8 or the average true range, ATR, helps you set a stop-loss that accounts for market volatility, reducing the chances of being stopped out prematurely. 3. Don't chase losses. Never move your stop-loss further away to avoid being stopped out. This is a recipe for disaster. Tools of the trade, indicators and patterns. New traders often feel overwhelmed by the sheer number of tools available. Start simple and focus on these essentials. 1. Volume, look for spikes in volume as a confirmation of breakouts. 2. Moving averages, use moving averages to identify trends and potential reversal points. 3. Candlestick patterns. Learn to recognize patterns like dojis, hammers, and engulfing candles. They often signal shifts in momentum. Key takeaways for success. To wrap it all up, here are the most important points to remember. Follow the smart money. Watch what institutions are doing. Their movements create the patterns you see on the charts. Understand market cycles. Knowing the phases of the market can help you enter and exit trades strategically. Patience pays off. The best opportunities often lie in the quiet accumulation phase, not during the hype of the markup phase. Protect your capital. Use stop losses wisely and always have a risk management plan. Ready to level up your trading? Now that you understand how the market works, what will you do differently in your next trade? Share your thoughts in the comments. I'd love to hear your strategies and experiences. And if you found this guide valuable, don't forget to like, subscribe, and share it with someone who's just starting their trading journey. Together, let's conquer the market! Have you ever stared at your screen in disbelief when your stop loss was hit, then felt a burst of anger or guilt? Like the market personally attacked you? Let's put an end to that mindset right now. A losing trade doesn't mean you failed as a person. It just means a specific market setup you took didn't pan out. That's it. Too many traders internalize every loss, scrambling to uncover a single root cause. But the market doesn't hand out tidy explanations. Sometimes unexpected news drops. Sometimes price just drifts the wrong way. Sometimes it's all of the above at once. When you take losses personally, you drag emotion into your strategy. That guilt, that frustration, they do more damage than the actual loss. They cloud your judgment, tempt you to overtrade, or pressure you to overhaul your system for no logical reason. Suddenly, one small stop-out turns into a chain of bad decisions, all because you couldn't let it go. The fact is, trading is a probability game. Every strategy has losers, and even top professionals face drawdowns. If you can't handle a normal slump, you'll bail out long before those hot streaks come back around. Think of a biased coin that lands heads 60% of the time. You can still get 3 tails in a row. The odds haven't changed. You just have to keep flipping. But when you take every loss to heart, the emotional toll is massive. You feel guilty, question your skills, scramble to win it all back. You might start ignoring your own risk rules or chasing random setups. That cycle of desperation leads to even bigger losses, which piles on more guilt. It's exhausting and entirely avoidable. If you look at each trade as just another spin of the probability wheel, you cut the emotional sting. A stop loss is there to save you, not punish you. If it gets triggered, it means that setup wasn't the winner you hoped for. It doesn't define who you are as a trader. Focus on the process. Did you follow your rules? Did you stick to your plan? If yes, then losing is simply part of the cost of doing business. Sure, it still stings a bit when you watch the market turn on you. We're human, but let it be a signal, not an anchor. If you believe in your edge and manage your risk, then 1, 2, or even 3 consecutive losses don't change your long-term odds. That's how professional traders endure. They don't see each stop-out as a personal attack, but as data, evidence of what went right or wrong in the broader scheme. And that's exactly why you should never take losses personally. You stay off the emotional roller coaster. You protect yourself from snap decisions and revenge trades. And you keep your eyes on the bigger picture. Stable, long-term profitability, not short-term frustration. Next time you see that stop-loss get triggered, don't waste energy demanding some perfect explanation. Accept that trading is all about probabilities and risk management. Losses happen. If you've stuck to your plan, you did nothing wrong. Let it go. If your system is solid, the wins will balance out the losses, provided you're still around to capitalize on them. Remember, a losing trade is not a personal failure. It's just another roll of the dice in the probability game we call trading. Commit to the process, keep executing, and keep your head clear of guilt or regret. You'll find that once you stop taking losses to heart, the market stops feeling like an adversary and starts becoming the arena where discipline, skill, and strategy can truly shine. If you found this helpful, hit that subscribe button and ring the bell so you don't miss future videos on trading psychology and strategy. Thanks for watching and happy trading. Imagine waking up one day, checking your portfolio, and seeing it's down 20% overnight. Your heart sinks, your mind races. What do? Sell everything? Double down? Or sit frozen watching it drop even further? Let me tell you something. Investing without a risk management strategy is like walking a tightrope without a safety net. But don't worry. By the end of this video, you'll know exactly how to protect your money even when the market's in free fall. The importance of risk management. Risk management isn't just for hedge funds or Wall Street pros. It's for anyone who wants to grow their wealth without sleepless nights. Here's a reality check. In 2022, over 85% of retail investors underperformed the market. Why? Most lacked a solid plan for managing risks when things went south. You might think, I'll figure it out when it happens. But that's like deciding how to put out a fire after your house is already in flames. So let's break it down. Diversification, the golden rule. Don't put all your eggs in one basket. We've heard it before, but do we practice it? Diversification is your first line of defense. In 2022, when tech stocks like Meta and Tesla lost over 60% of their value, energy stocks, think ExxonMobil and Chevron, skyrocketed, with gains exceeding 50%. Investors who spread their money across different sectors softened the blow of the tech meltdown and even came out ahead. So what does diversification look like? It's not just about picking a few different stocks. It means balancing your portfolio with a mix of stocks, bonds, ETFs, and even international assets. If one sector tanks, others can keep you afloat. Position sizing. Don't bet the farm. Here's a simple question. Would you gamble your entire life savings on a single roll of dice? No? Then why risk it all on one stock or asset? Position sizing ensures no single investment has the power to wreck your portfolio. For example, when Silicon Valley Bank collapsed in early 2023, investors who had heavy exposure to banking stocks saw significant losses. But those who followed the rule of limiting individual positions to 5% or less of their portfolio, they shrugged it off and moved on. Position sizing isn't just smart, it's essential. Stop-loss orders, your safety net. Let's talk about stop-loss orders, the unsung heroes of risk management. A stop-loss automatically sells your stock if it falls below a certain price. Think of it as a seatbelt. It doesn't prevent accidents, but can save your life during one. During the crypto crash in late 2022, Bitcoin dropped below $16,000. Investors who had stop-loss orders in place limited their losses, while others watched their portfolios nosedive. Setting stop-losses isn't a sign of weakness, it's a sign of wisdom. Hedging, the insurance policy for your portfolio. Imagine you could buy insurance against market crashes. Well, you can. It's called hedging. Options, inverse ETFs, and even gold can act as a shield during volatile times. Take the U.S. debt ceiling crisis in mid-2023. Savvy investors used option strategies and inverse ETFs to offset losses when markets wobbled. Hedging doesn't eliminate risk, but it makes the punches hurt a lot less. Cash reserves. The forgotten hero. Cash is often overlooked in risk management, but it's your secret weapon during market downturns. When the banking sector faced turmoil in 2023, investors with cash reserves didn't just sit on the sidelines. They swooped in and bought quality stocks at discounted prices. Holding cash isn't about missing out on gains. It's about being ready for opportunities. Remember, in investing, patience often pays off. Mindset matters. Be the calm in the storm. Here's the thing. The market is unpredictable. Corrections, crashes, and volatility are inevitable. But what separates successful investors from the rest isn't their ability to avoid losses. It's their ability to manage them. Think of the greatest investors like Warren Buffett. They don't panic during downturns. Instead, they see them as opportunities to strengthen their portfolios. Risk management isn't just a strategy, it's a mindset. Final thoughts. Risk management is your parachute in the wild ride of investing. Diversify, size your positions wisely, use stop losses, hedge when necessary, and always keep cash reserves ready. The market will test you. It's not a matter of if, but when. But with the right strategy, you can navigate any storm and come out stronger. Because in the end, investing isn't about avoiding risks. It's about mastering them. And now you've got the tools to do just that. You have spent years building a solid stock portfolio. You have carefully chosen companies that you believe in, and you have watched your investments grow. It feels good, right? But then, out of nowhere, market turbulence arrives. A major global event hits the headlines. Suddenly, your carefully built portfolio starts to shrink. Your gains begin to slip away. What do you do in this moment? Do you simply watch, hoping the market recovers? Or do you take action to protect what you have worked so hard to achieve? This is where hedging comes into play. Think of hedging as a type of insurance for your investments. You cannot predict the future. You cannot know exactly when the market might tumble, but you can prepare for it, and that is what hedging is all about. It is not about guessing the next crisis. It is about giving yourself a safety net so that when a downturn happens, you have a plan in place to limit how much it hurts. Before we get into how to hedge, let's explore why it matters. Consider a very real historical moment. Early in the year 2020, when the pandemic sent shockwaves through the markets. Investors saw steep declines in a matter of days. Portfolios that took years to build were slashed dramatically. Investors who had hedged their portfolios, however, were not immune to losses, but they were able to soften the blow. They had strategies and tools that helped keep their losses manageable. Without hedging, many people found themselves scrambling, forced to sell stocks at poor prices or endure sleepless nights, wondering if their retirement plans were in jeopardy. Now let's talk about actual ways to hedge. One common tool is the put option. If you are new to investing, an option might sound complicated. But think of it this way. A put option is like a contract that says, no matter how low a stock's price goes, I will still have the right to sell my shares at a certain price. That certain price is called the strike price. By buying a put option, you are essentially paying a small fee, often called a premium, to guarantee that you can sell your shares at that predetermined price if the market tanks. Let's break down a practical example in detail, speaking slowly and clearly so you can truly understand the concept. Imagine that you own 100 shares of a well-known retail company, and each share is currently worth $50. You worry that the company's upcoming quarterly earnings report might disappoint investors and cause the stock price to fall. Instead of simply crossing your fingers and hoping for the best, you buy a put option. This put option might give you the right to sell your shares at $48 each. It will cost you, let's say, $2 per share for this right. Notice that I am spelling out the numbers as words for clarity. If the earnings report is worse than expected and the stock plummets to $40 per share, what happens? Without the put option, you would be stuck holding shares now worth $40 each, meaning you have lost $10 per share. With the put option, though, you can still sell your shares at $48 each. Yes, you paid $2 per share for the option and you still face some loss. But that loss is now only a fraction of what it could have been. Instead of losing $10 per share, you lose about $4 per share total. The difference between losing $4 per share and losing $10 per share is enormous when you consider a large position in a portfolio. This peace of mind can be priceless during uncertain times. Another way to hedge is with something called a covered call. This is often used if you believe your stock might not rise significantly in the short term. With a covered call, you already own the stock, and you then sell a call option against your shares. By doing this, you collect a premium up front. If the stock does not rise above the call option's strike price by the time the option expires, you keep that premium as extra income. If the stock does rise above the strike price, you might have to sell your shares at that price, but remember, you receive that premium, which helps cushion any potential downside. This approach can be especially helpful if you are looking for steady income and mild protection, but do not expect the stock to shoot up rapidly. If you have a larger and more diversified portfolio, futures contracts can come into play. Futures might sound intimidating, but think of them as agreements to buy or sell something at a certain date and a certain price. With stock index futures, like futures on a major market index, you can essentially bet on the market going down if you think there is trouble ahead. If the market indeed falls, the profits on your futures position can help offset the losses in your stocks. Picture this. You have a broad portfolio tracking the market, and you decide to sell an index futures contract as a hedge. When the market falls, yes, your stocks lose value, but your futures position gains value, helping smooth out the overall hit to your total investment account. Now you might ask, when should I hedge and how often? Hedging is not about timing the market perfectly. You are not trying to guess the exact day or week when prices might drop. Instead, you are preparing for the idea that unexpected events can occur at any time. Maybe you hedge during earnings season when many companies announce their results and stocks can swing widely. Maybe you hedge when global economic uncertainty is high, such as during political tension, changes in interest rates, or times when financial experts seem particularly anxious. Or maybe you simply decide that once your portfolio grows beyond a certain value, you always keep some form of hedge in place as a standard risk management practice. Think of hedging costs as similar to paying insurance premiums. Insurance is not free, and hedging is not free either. Buying options costs money. Selling options might limit your upside potential. Futures could mean tying up some capital. But what is the cost of not hedging? If you never hedge, you might face the risk of large, sudden losses that can set back your financial goals by months, years, or even decades. By proactively hedging, you accept a small, manageable cost now rather than risking a huge loss later. For new investors, it might feel daunting. But remember, you do not have to hedge your entire portfolio at once, and you do not have to be an expert trader. You can start small. Try hedging a single position that you are particularly nervous about. Test how it feels. Understand what it does for your peace of mind. Over time, as you grow more comfortable, you can expand your hedging strategies. Also, consider that hedging makes you a more mature investor. Instead of reacting emotionally to market drops, selling at the worst possible time, or holding on to hope without any plan, you become an investor who has prepared for the storm. With a hedge in place, you can sleep better at night, knowing that a sudden headline or unexpected event will not completely derail your plans. You are not betting on disasters. You are simply acknowledging that the market can and will move unpredictably, and you want to stay in control of your own financial destiny. At the end of the day, hedging is about balance. You do not want to overhedge and pay too much for protection you do not need, just like you would not want to pay excessively high premiums for insurance that does not make sense. But you also do not want to leave your investments completely exposed in a world filled with uncertainties. Consider your comfort level with risk. Consider your investment goals and your time horizon. If your portfolio is meant to fund your retirement or help you achieve important life goals, protecting it might be worth the cost. As you move forward, think critically about what steps you will take to secure your financial future. If any of this sounds complex, do not hesitate to learn more. Seek guidance or practice on a smaller scale. The goal is not to become a hedging expert overnight. The goal is to understand that this tool exists and can be used to your advantage. If this explanation helped clarify the concept of hedging, consider sharing this knowledge with other investors. Give this video a like if you found it useful, and subscribe for more insights on managing risk, finding opportunities, and becoming a more confident, resilient investor. With the right tools and a mindful approach, you can navigate both calm and stormy markets alike, always prepared for whatever tomorrow may bring. Are you paying hidden fees and missing out on bigger returns? Are high fees silently eating away your hard-earned money? Have you ever felt like you are putting in all the effort, yet someone else is reaping most of the rewards? In today's video, I will pull back the curtain on mutual funds and index funds, two popular investment paths that can either help you grow your wealth or drain it through hidden costs. By the end of this video, you will understand the surprising truth behind mutual fund fees and why they can eat into your returns. How index funds offer a simpler, more cost-effective strategy. Two specific index funds in India that many seasoned investors are using right now. Do not miss out, because if you stay till the end, you will walk away with all the insights you need to stop paying needless fees and keep more of your returns in your pocket. Ready to take control of your financial future? Let us dive right in! What exactly are mutual funds? A mutual fund is like a money pool where many investors contribute their funds together. This pool is managed by a professional fund manager who decides which stocks or bonds to buy, hold, or sell. The main pitch is, you do not have to worry about the nitty-gritty of stock picking. Let the experts handle it. But is it really that simple? Mutual funds are often described as actively managed. This means the fund manager is frequently buying or selling stocks, aiming to outperform a certain benchmark, like the Nifty 50. While this sounds good in theory, active management typically comes with a higher cost. One of the most critical costs in mutual funds is the expense ratio, usually anywhere from 1% to 2% annually. On the surface, paying 1 or 2% might not sound like a big deal, but consider the power of compounding. Over the course of 10, 15, or 20 years, these fees add up significantly, eating into the returns you could be enjoying. Mutual funds sometimes have other fees, such as exit loads if you redeem your investment within a certain time frame, transaction costs, and even performance fees in some cases. Have you ever felt that your fund's value does not grow as quickly as advertised? These hidden fees could be the reason. Ask yourself, have you ever checked the annual expense ratio of your mutual fund? If not, you might be missing a huge piece of the puzzle. Behind the scenes, here is how mutual funds operate. You invest, your neighbor invests, and thousands of other people invest. All this money goes into one collective pool. The fund manager studies the market, tries to pick stocks or bonds that will do well, and aims to buy low and sell high. With every buy or sell, the mutual fund might incur brokerage and other costs, and these can get indirectly passed on to you in the form of higher expense ratios. Because the fund manager is actively making decisions, the hope is to beat the underlying benchmark index. But multiple studies globally have shown that a significant percentage of actively managed mutual funds fail to beat their benchmark indices over the long run. So, while you are paying higher fees for expert management, you might not always be getting the results that justify those costs. How would you feel if after paying all those fees, your mutual funds still underperformed the market? Now, let us introduce index funds, which many seasoned investors consider one of the best-kept secrets in the investment world. An index fund aims to replicate a specific market index rather than beat it. For example, an index fund tracking the Nifty 50 will buy and hold the same 50 stocks in the same proportion as the index. Since an index fund is just mirroring an index, there is no expert picking and choosing which stock to buy or sell. Because of this, you do not have to pay for expensive active fund management. This results in significantly lower expense ratios, often between 0.1% and 0.2%. That means more of your money stays invested and compounds over time instead of getting siphoned off by fees. If you are thinking, why would I settle for just matching the market? Remember that many active mutual funds actually fail to beat the market consistently, especially after accounting for fees. Would you rather pay 2% for a fund that might not outperform the market? Or 0.2% for a fund that aims to match the market's growth? If you are still not convinced that fees matter, let us dive into the numbers. We often talk about the power of compounding in terms of growing wealth, but compounding also applies to fees. Imagine you have 10 lakh rupees invested in a fund charging 2% annually. The 2% might be 20,000 rupees in the first year. Over 20 years, the lost amount to fees, plus the returns that money could have generated if it had stayed invested, can become quite large. In contrast, an index fund with a 0.2% annual expense ratio means you would only pay about 2,000 rupees in the first year on a 10 lakh investment. Over 20 years, the difference becomes staggering. This is why many investors opt for index funds. Less money in fees, more money compounding for your future. So, how much of your wealth are you willing to give up in fees, especially when there is a cheaper alternative right next door? Expense ratios are not the only costs you may face when investing in mutual funds. There's also the exit load, a fee some mutual funds charge if you withdraw your funds within a specific period, often 1 year or 18 months. If you need to access your money in an emergency or decide to switch funds, you might have to pay this penalty. On top of that, actively managed funds can incur more frequent trading costs, which eventually get passed on to investors. Some funds even charge performance fees if they surpass a certain target, further reducing your share of the gains. Have you ever tallied up all the mutual fund fees you have paid over the years? It might be eye-opening. Let us now put mutual funds and index funds side by side. Mutual funds usually have an expense ratio between 1% and 2%, while index funds often charge between 0.1% and 0.2%. Mutual funds are actively managed, whereas index funds are passively managed, simply aiming to match the market. Mutual funds might include exit loads, performance fees, and high transaction costs, while index funds are generally much simpler and come with fewer fees. Finally, mutual funds aim to beat the market, although many fail to do so over the long term, while index funds aim to track the market and often end up outperforming most actively managed funds after fees. Now that you see the stark difference, which approach aligns more with your investment philosophy? I promised earlier to share some well-known index funds in India, so here they are. First is Nifty BS, an exchange-traded fund that tracks the Nifty 50 index. It invests in the top 50 companies listed on the National Stock Exchange. If you want to capture the performance of India's largest and most established companies, Nifty BS is a good starting point. Second is Junior BS, another ETF that tracks the Nifty Next 50 index, often referred to as the mid-cap segment. It consists of top companies that are not in the main Nifty 50, but are right behind them in terms of market capitalization. This fund offers exposure to a more growth-oriented set of companies. Both Nifty Bs and Junior Bs are listed in NSE and BSE and can be brought through any demat account. Did you know that just 2 ETFs could give you a massive slice of the Indian market? You might wonder how to structure your portfolio using these index funds. A commonly recommended strategy is the 60-40 ratio between large cap and mid cap investments. 60% goes to large cap, which could be Nifty BS, representing stability and more established growth. 40% goes to mid cap, which could be Junior BES, representing higher growth potential but slightly higher volatility. This balance ensures you get both stability and a chance to capture bigger gains if mid caps surge. Are you comfortable allocating 40% of your portfolio to mid-cap stocks for the opportunity of higher returns? Or would you prefer a more conservative approach? One reason many seasoned investors recommend index funds is simplicity. Rather than analyzing hundreds of mutual funds, trying to pick the best manager and hoping they continue to deliver stellar performance, you can simply pick 2 or 3 index funds or ETFs, like Nifty Bs for large cap, Junior Bs for mid cap, and perhaps one additional fund for international exposure. And be done. Researching and tracking actively managed funds can be time-consuming. Index funds cut down on this drastically because you just need to ensure the fund continues to track its benchmark accurately. Also, because index funds stick to an index, there is less emotional trading involved. You do not constantly worry about whether your fund manager might reshuffle everything overnight. Historically, many index funds in developed markets have outperformed the average actively managed fund over the long term. While Indian markets are still growing and actively managed funds sometimes outperform in short bursts, the long-term trend often mirrors global patterns. Is it not reassuring to know that you could spend less time monitoring your investments and still capture solid market returns? By now, you might be thinking, should I just sell all my mutual funds and jump into index funds? That depends on your individual situation, risk tolerance, and investment horizon. Before exiting your mutual funds, check their long-term performance of 5 years or more and evaluate the expense ratio. If your mutual fund has been consistently beating the market even after fees, you might consider keeping it. But if the costs are high and performance is not impressive, it may be time to reevaluate. You do not necessarily have to go all in on one strategy. Some investors maintain a core in index funds for market returns and keep a small portion in select mutual funds that have a strong track record. If you are unsure, consult a professional financial advisor to help you navigate tax implications, exit loads, and other considerations. Let us address a few misconceptions that might be holding you back from choosing index funds. First, you might think, index funds only match the market and I want to beat it. But remember, most active funds fail to outperform their benchmarks in the long run, especially when you factor in fees. Second, index funds are boring. Yes, they can be considered boring because there is no daily drama of buying and selling, but boring can be a good thing if it means steady, reliable growth without high fees. Third, some people believe that expense ratios do not make much difference. However, the compounding effect of 1 or 2% in fees over 20 years can erode a significant portion of your wealth. Even a 1% difference in fees can translate into a large sum of money lost over time. Would you rather chase excitement or real long-term growth? Here are the key takeaways. Mutual funds can have potential short-term outperformance and professional management, but they also come with high expense ratios, exit loads, and more frequent trading costs. Index funds have low expense ratios, simplicity, diversification, and less room for human error, but they will never beat the market because they essentially are the market. Consider a 60% allocation to Nifty Bs for large-cap stability, and 40% to Junior Bs for mid-cap growth. Review the fees you are paying in your current mutual funds, compare the historical returns net of fees to index funds, and decide if making the switch or adjusting your allocation might benefit your financial goals. There you have it, the critical differences between mutual funds and index funds, how fees and expenses could quietly erode your returns, and why you might consider moving some or all of your money into index funds like Nifty Bs and Junior Bs. Investing is a long-term journey. Even seemingly small percentages in fees can have a massive impact when compounded over decades. Are you ready to make informed decisions and ensure more of your money stays invested, growing for your future instead of lining someone else's pocket? If you found this video helpful, do not forget to like and subscribe for more deep dives into personal finance, investment strategies, and wealth-building tips. Thank you for watching, and I will see you in the next video. You're at your computer, heart pounding, eyes glued to the screen. You've researched a particular stock or cryptocurrency for hours. Everything seemed perfect until the market turned. That small dip morphed into a gaping loss. You hesitate, unsure whether to exit or hold, and before you know it, a big chunk of your hard-earned money evaporates. If this sounds familiar, you're not alone. Many new investors and traders suffer the same fate by letting big losses gut their portfolios. Today, we're going to flip that script. We'll uncover why consistency and capital preservation are the real keys to long-term success. We'll talk about viewing every dollar as a soldier, each one working to bring more soldiers home. And we'll draw inspiration from cricket legend Virat Kohli, who didn't score massive runs by being reckless, but by staying at the crease, not getting out cheaply. By the end of this session, you'll understand how to protect and grow your portfolio steadily, how to stay in the game, and nurture your capital instead of watching it vanish in a single blow. In the financial markets, consistency is king. Flashy gambles might sometimes pay off, but true wealth building comes from disciplined, repeatable actions over the long haul. It's like running a marathon instead of sprinting. You don't need to hit a home run every time. You need to keep moving forward without suffering catastrophic setbacks. Consistent investing allows you to navigate volatility with confidence. It prevents emotional decision-making and ensures you survive to seize future opportunities. Without consistency, one bad bet can knock you out of the game entirely. Think of each dollar as a soldier. Your dollars head into the market with a mission, to return with reinforcements. If too many soldiers are lost in reckless battles, your army shrinks, making future gains harder. Protect your capital as if it were a well-trained unit. Don't send your troops into hopeless fights. Cut losses early and preserve your ability to fight another day. Consider Virat Kohli's approach in cricket. He didn't become a batting maestro by swinging wildly at every ball. He built his innings steadily, ball by ball, refusing to give his wicket away cheaply. That's how he accumulated big scores, by staying in the game. As an investor, you can't make consistent gains if you're knocked out early by one disastrous trade. Like Kohli, stay at the crease financially. Protect your capital so you can keep investing, keep compounding, and keep growing your wealth over time. How do you achieve this consistency? It starts with discipline and a clear plan. Know when you'll enter a position, how much you'll risk, where you'll place a stop loss, and when you'll take profits. This isn't guesswork, it's strategy. Avoid risking large portions of your portfolio on single trades. Even the best traders lose sometimes. The difference is they cut losses quickly instead of letting them spiral. Accepting small, manageable losses ensures you'll have capital left to invest tomorrow. Wealth doesn't materialize overnight. Compounding requires patience and steady growth. A 10% gain on a sizable portfolio is far more meaningful than a 100% gain on a tiny one. By preserving your base capital, you enable consistent progress. Over months and years, these steady gains add up dramatically. Kohli's centuries came from carefully selecting his shots over long innings. Similarly, your portfolio's strength comes from gradual, deliberate decisions over time. Markets are emotional roller coasters. Headlines, tweets, and sudden price swings test your nerves. But emotional trading leads to destructive decisions. Train yourself to remain calm. Stick to your risk management rules, trust your plan, and resist the urge to panic or chase quick fixes. Imagine starting with $10,000. A single bad trade that halves your account to $5,000 now requires a 100% return just to break even. Recovering from big losses is far harder than avoiding them in the first place. Consistency and careful risk management spare you from these crippling setbacks. Here's a simple blueprint. 1. Start small. Begin with manageable positions to understand market behavior. 2. Quality over quantity. Wait for the right opportunities. Don't force trades. 3. Clear rules. Define entry, exit, and stop-loss levels up front. 4. Journaling. Track and review your trades to continuously improve. 5. Probabilistic mindset. Accept that not every trade will win and manage risk accordingly. Just like Kohli didn't score big from the locker room, you can't grow your wealth if you're out of the market. Consistency keeps you in the game longer, letting you capitalize on future opportunities. Play it safe when conditions are tough, and press your advantage when they're in your favor. Don't chase excitement at the expense of stability. Often the most boring strategies, those focused on small, steady gains, prove to be the most effective. Just as a disciplined athlete endures repetitive training, a disciplined investor sticks to a process that may feel uneventful but leads to long-term triumph. Drawdowns happen. Treat them as lessons rather than catastrophes. Did you break a rule? Were emotions involved? Over time, you'll refine your approach and become a more resilient investor. Sometimes the best move is no move at all. If conditions aren't right, staying on the sidelines can protect your capital. Just like a batsman leaving a ball that's too risky, an investor can pass on setups that don't meet their criteria. Study successful investors. You'll see they prioritize capital preservation and consistent execution over flashy gambles. They know that the secret to long-term wealth lies in a solid process, not in one-off windfalls. Keep records, identify your strengths, and refine your techniques. Resist the urge to chase every hot tip you see. Most big talkers don't show their failures. Stay true to your plan and trust the process. Markets change. At times, caution is vital. At others, you can be more aggressive. The consistent investor adapts without abandoning core principles. Like a seasoned player adjusting to different bowling conditions, you tweak strategies while preserving capital. Consistency grants you the freedom to build real wealth over time. wealth that can support your future, your family, and your long-term goals. No single jackpot trade can match the reliability and scalability of compounding returns earned through discipline. This is your blueprint. Consistent, disciplined investing, anchored by rigorous risk management and the unwavering goal of protecting your capital. Think of Virat Kohli standing firm at the crease, and remember that you can't score if you're knocked out early. Embrace steady growth, value your soldiers, and never let one trade erase years of progress. Over time, this mindset transforms your portfolio into a formidable army, marching toward financial freedom. Consistency, though not glamorous, is the bedrock of lasting success in the markets. It's late 2019 and everything seems normal. The markets are steady, and most people are optimistic. But take a closer look at the stock charts, and you'll see something unusual. Prices are quietly slipping, breaking key support levels. Those who know how to read these patterns sense trouble brewing months before the world even hears about a pandemic. That's the power of technical analysis. It's not magic, but it feels like it when you see how much the charts reveal. Today, we're going to explore why technical analysis might be the ultimate tool for retail investors, especially if you're just starting out. Now, let's be real. If you've ever tried to understand investing, you've probably heard of fundamental analysis. It's all about looking at the details: earnings, debt, company management, and even macroeconomic factors like inflation and global politics. Fundamentally, these are the forces that move the markets. But here's the catch. How practical is it for you as a retail investor to gather and analyze all this data? Do you have hours to spare dissecting company reports or the resources to get insider-level insights? Most of us don't. Fundamental analysis is like solving a massive jigsaw puzzle, where some pieces are missing and others are hidden behind locked doors. It's undeniably important, but let's face it, it's out of reach for most retail investors. This is where technical analysis comes to the rescue. Instead of trying to gather every piece of data, technical analysis focuses on the price chart, a visual representation of everything happening in the market. Every big event, every small sentiment shift, and even insider moves leave their footprints on the charts. If you learn to read these footprints, you can make smarter decisions without needing a degree in finance. Let me give you some real-world examples to show you how powerful this approach can be. First, let's talk about the COVID crash. In late 2019, well before the world started worrying about a pandemic, the stock charts were already sending warnings. Major indices like the S&P 500 were breaking key support levels, hinting that something big was coming. If you were watching the charts, you'd have seen the signs early and could have protected your investments, or even profited from the downturn. Next, let's look at the 9/11 attacks. Of course, no one could have predicted the tragic events themselves. But the stock charts in the days leading up to 9/11 showed unusual activity, an unexplained downturn, and increased volatility. It's as if the market sensed that something disruptive was about to happen, even though the specifics were unknown. And who could forget the 2008 financial crisis? Long before the housing market collapsed and Lehman Brothers declared bankruptcy, the charts were flashing red flags. Patterns like the head and shoulders formation and consistent declines in key sectors warned of an impending crash. Those who understood these patterns had months to prepare, while others were caught off guard. Do you see the common thread here? The charts don't predict events, but they reveal the collective actions of millions of market participants. And among those participants are people and institutions with access to information that most of us don't have. When you learn to read the charts, you're essentially tapping into the collective wisdom and sometimes the secrets of the entire market. Now, let's make this practical. Have you ever looked at a price chart and thought it seemed random, like a jumble of ups and downs? It's not random. Those movements are a reflection of human behavior: fear, greed, and decision-making at scale. Once you learn the basics of technical analysis, you'll start to see patterns that repeat themselves over and over again. For example, you'll notice trend lines. These are straight lines that connect the highs or lows of a stock price over time. They help you understand the overall direction of the market, whether it's going up, down, or sideways. Knowing the trend alone can give you an edge, because it's often smarter to trade with the trend rather than against it. You'll also come across support and resistance levels. These are price points where the market tends to pause or reverse. Think of support as the floor holding the price up and resistance as the ceiling keeping it down. When a stock breaks through these levels, it often signals a significant move, either up or down. And then there are chart patterns like triangles, flags, and head and shoulders formations. These patterns don't just look cool, they're signals that often precede major price moves. For example, a bull flag might indicate that a stock is gearing up for another upward push, while a head and shoulders pattern might warn of a downturn. Here's the best part. You don't need expensive tools or insider access to start using technical analysis. There are plenty of free charting platforms online that let you draw trend lines, identify patterns, and add simple indicators like moving averages. All you need is a willingness to learn and a bit of practice. And if you're wondering, why should I focus on technical analysis when fundamentals are what truly move the market? The answer is accessibility. As a retail investor, you don't have the same tools, time, or resources as big institutions. But with technical analysis, you can see what they're doing and respond accordingly. It's like having a window into the actions of the smartest money in the market. Let's wrap this up. While fundamental analysis is undeniably important in the grand scheme of things, it's not always practical for retail investors. Technical analysis, on the other hand, gives you a powerful, accessible tool to understand market trends, spot opportunities, and protect yourself from risks. The charts don't lie. They know everything that's happening in the market. You just need to learn how to read them. So are you ready to take control of your investing journey? Hit that subscribe button, leave a comment, and let's start mastering the market together. Your journey into technical analysis begins today. Are your mutual funds just sitting idle in your demat account waiting for long-term gains? If so, you're missing out on unlocking their true potential. Consistent, extra income generation. In this video, I'm revealing a game-changing strategy that savvy investors use to generate steady income by selling options backed by their mutual funds. You'll learn how to decide whether to sell calls or puts based on market trends, select the right strike price and expiry, and even pledge your funds step by step. Let's dive in. The strategy: selling options. The key to this strategy is selling options. Once you've pledged your mutual funds, you can use the margin to sell options and generate extra income. But here's the question: should you sell call options or put options? The answer depends on the market conditions, so let's break it down. Scenario 1. If the market has risen significantly. For instance, if Nifty has already gained around 11 to 12% or more in the past year, it's unlikely to move much higher in the short term. In this situation, you should sell call options at strike prices around 15% higher than the current market level. For example, if Nifty is trading at 23,800, sell calls at strike prices like 27,400 or above. This keeps your risk low while allowing you to earn premiums effectively. Scenario 2. If the market has fallen or is flat. If Nifty has been flat or has fallen significantly over the past year, it's more likely to rebound. Here, you should consider selling put options instead. Choose strike prices near key support levels such as the 200-day moving average, 200 DAMA, or multi-year lows, or the 100-week moving average. For example, if Nifty is having a support level like 21,000, sell puts at 21,000 or slightly below to create a safe buffer. By aligning your strategy with market trends and historical data, you significantly reduce your risk while maximizing your chances of earning consistent premiums. Why selling yearly options is best for beginners. Now let's talk about the expiry. You might wonder, should you sell weekly, monthly, or yearly options? For new investors, my recommendation is to sell yearly options because they offer several advantages. Reduced volatility risk. Yearly options are less affected by short-term market fluctuations, making them safer for beginners. Higher premiums. Longer duration options often provide higher premiums, giving you better returns. Low maintenance. Selling yearly options means fewer transactions and less time spent monitoring the market. For beginners, it's always best to stick to far out of the money yearly options. This ensures minimal risk while generating consistent income. The solution: pledging mutual funds. So how do you fund these trades without tying up additional capital? This is where pledging comes into play. Pledging lets you use your mutual funds as collateral to access margin for trading. Think of it like using your house as security for a loan. You still own the house, but now you're using its value to generate more income. Here's how it works. When you pledge your mutual funds with your broker, you receive a margin based on their value. This margin can then be used to sell options, creating a new stream of extra income. Instead of letting your funds sit idle, you're actively putting them to work while retaining ownership. How to pledge your mutual funds. Pledging your mutual funds is a simple process. Log into your demat account. Look for the section labeled Pledge or Margin Against Securities. Here you'll see your mutual fund holdings that are eligible for pledging. Select the mutual funds to pledge. Choose the funds you want to pledge, and the system will show you the margin amount you can receive. Confirm the pledge request. Once you confirm, your broker processes the pledge and the margin becomes available in your account. Contact your broker for help. If you can't find the pledge option, simply contact your broker. They'll guide you through the process and ensure your funds are pledged without hassle. Within a day or two, your funds will be pledged and you'll be ready to start generating extra income. What if your mutual funds aren't pledgeable? Here's a common question. What if your mutual funds can't be pledged? The solution is simple. Switch to index funds. Index funds, like those tracking Nifty or Sensex, are highly liquid and can be easily pledged with most brokers. They also typically have lower expense ratios, meaning more of your money stays invested. By switching to index funds, you maintain flexibility and ensure your investments are ready to generate extra income. Are you currently generating extra income with your mutual funds, or are you considering switching to index funds? Let me know in the comments below. I'd love to hear your thoughts and answer any questions. Don't let your investments sleep in your DEMA account. Start pledging your mutual funds or shift to index funds today to unlock consistent extra income. If this video gave you valuable insights, please like this video, share it with your friends, and subscribe to Mastering Market for more smart investing strategies. Thanks for watching, and I'll see you in the next video. Have you ever placed a trade that seemed perfect until the market flipped in an instant and left you watching your account balance drop like a rock? If so, you're not alone. Most traders face that sinking feeling at some point. The difference between those who recover and those who burn out is effective risk management. In this video, we'll break down the key elements of risk management and then dig deeper, showing you exactly how to use these tools to safeguard your capital, boost consistency, and build long-term success. Stick around because understanding these concepts can truly transform your trading journey. Risk management isn't just about using stop losses or limiting how much money you put into a single trade, though that's part of it. It's a holistic framework that guides every decision you make, from what markets you trade, to how much of your capital you allocate, to when you exit positions. Think of it this way. You wouldn't drive a car at top speed without brakes, seatbelts, or airbags. Similarly, trading without risk management is like racing down a financial highway with no safety measures in place. So what are the core constituents of a solid risk management strategy? Let's break them down into 5 key areas. 1. Position sizing, determining how much capital you allocate to each trade. 2. Stop-loss placement, setting predefined exit points to limit losses. 3. Risk-reward ratios, balancing potential losses against potential gains. 4. Diversification and correlation management, spreading your bets across different assets and strategies. 5. Emotional discipline and rules enforcement, sticking to your plan, even when it's tempting to deviate. These 5 pillars work together like a well-oiled machine. Each part reinforces the others, ensuring you stay in control, even when markets throw you a curveball. Position sizing is where it all starts. Without a clear method to determine how much capital you put into a trade, you risk putting too many eggs in one basket. For example, let's say you have a $10,000 account. One trader might throw the entire $10,000 into a single stock trade because they're confident about it. Another trader, with proper risk management, might decide to risk only 1% of their capital, $100, in that trade. If the trade goes wrong, the first trader could face a catastrophic loss.